The UK housing market isn't just slowing down, it's locking up. What we're seeing right now isn't a normal cooling cycle or a short pause after a boom. It's a system that's losing its ability to function properly. Prices look stable on the surface, but underneath, activity is drying up, confidence is draining away, and the basic mechanics that allow people to buy, sell, move, and build are grinding to a halt. This is the kind of situation that doesn't scream crisis at first, it whispers it, and those whispers matter. Before we go any further, if you care about the UK property market, if you want clear data, honest analysis and no sugarcoating, make sure you like this video and subscribe to the channel. This is UK Property Report, and every week we break down what's really happening behind the headlines. Liking the video helps more people see it, subscribing keeps you informed, and trust me, what's coming next in this market is something you'll want to stay ahead of. Right now, the average UK home costs around £270,000. On paper, prices are still rising slightly year on year, but once you adjust for inflation, that growth almost disappears. In real terms, many homeowners aren't gaining value at all. Some are quietly losing it. That's a big shift for a country where housing has long been treated as a guaranteed way to build wealth. When real prices stall, the psychological impact can be just as powerful as an outright fall. Housing in the UK is not just somewhere people live, it is the backbone of household wealth. A majority of family wealth in this country is tied directly to property. When house prices stop rising in real terms, people feel poorer even if their home value hasn't dropped outright. That feeling changes behaviour. People spend less, they take fewer risks, they delay big decisions. The slowdown spreads outward into the wider economy. One of the clearest warning signs right now isn't price, it's volume. The number of homes actually being bought and sold has dropped sharply. Transactions are down by roughly a third compared to recent highs. That is not a small adjustment. A healthy housing market relies on movement, people buying, selling, upsizing, downsizing. When that movement stops, the system begins to seize up. Low transaction volumes create a dangerous illusion. Prices appear stable because very few homes are changing hands. But that stability is artificial. It's built on inactivity, not strength. Sellers hold back, hoping conditions improve. Buyers wait, worried they'll overpay. Developers pause projects. The market doesn't correct smoothly, it freezes. And frozen markets don't stay frozen forever. Eventually, something cracks. Look across the country and the picture becomes even clearer. A handful of areas are still seeing strong price growth, often because they remain relatively affordable, but large parts of the southeast and many commuter towns are seeing stagnation or outright declines. London, once the engine of the entire market, has lost momentum. This kind of regional split is not a sign of health, it's a sign of strain. Fragmentation hides risk. National averages smooth over pain in specific regions, but housing stress doesn't need to be universal to be dangerous. It only needs to hit enough people in enough leveraged positions to change behaviour. When homeowners in certain areas feel stuck or exposed, confidence drains from the entire system. Mortgage affordability sits at the centre of this slowdown. Even though interest rates have come off their peak, borrowing remains far more expensive than it was just a few years ago. Monthly repayments take up a much larger share of income. Stress tests remain tight. Many buyers who could afford a mortgage in 2021 simply can't qualify today, even if prices haven't risen. For first-time buyers, the barrier is even higher. Deposits of £60,000 or £70,000 are now common outside London. Inside the capital, the numbers are far worse. At the same time, rents continue to rise faster than wages. That combination is toxic. High rent makes it harder to save. Lack of savings keeps people renting. And the longer people rent, the further away ownership becomes. This is where the housing ladder breaks. Without first-time buyers, chains collapse. Existing owners can't sell. Upsizers delay moves. Downsizers stay put because suitable alternatives are scarce or overpriced. Fewer moves mean fewer transactions. Fewer transactions mean less confidence. The system feeds on itself in the wrong direction. The banking system is deeply tied to housing. Mortgages make up the majority of lending on UK bank balance sheets. That's not a problem when prices are rising and borrowers are building equity. It becomes more uncomfortable when prices stagnate and refinancing slows. Risk doesn't disappear in these conditions, it concentrates quietly. Negative equity is not widespread yet, but the conditions for it are forming in certain areas. Buyers who entered the market at peak prices with small deposits are vulnerable if values dip even modestly. History shows how quickly this can spread once confidence turns. People trapped in negative equity don't move, they don't spend, they don't take risks, they become anchors in the system. Construction tells another part of the story. Housing development responds quickly to weak demand signals. When sales slow, projects are delayed or cancelled. New starts fall. Jobs are lost. The construction sector employs millions of people across the UK, and housing is a major driver of that employment. A slowdown here ripples directly into the labour market. Local councils are also feeling the pressure. Property activity supports local government finances through taxes, fees and development contributions. At the same time, councils face rising costs for social care and housing support. When housing slows, revenues weaken just as demand for services increases. That combination is already pushing some councils into financial distress. The rental market, often described as a safety valve, is no longer relieving pressure. As buying becomes harder, demand for rental homes rises. Supply does not keep up. Rents continue to climb faster than wages in many areas. That squeezes tenants further, reduces saving capacity, and locks more people out of ownership for longer. Buy-to-let investors, once a major source of rental supply, are pulling back. Higher borrowing costs, heavier regulation and weaker returns have made the sector less attractive. As landlords sell up, rental stock shrinks, less supply pushes rents higher, the pressure intensifies again. This environment widens inequality. Older homeowners with significant equity remain insulated. Younger households face high housing costs whether they rent or try to buy. Home ownership rates among younger adults are far lower than they were for previous generations at the same age. A frozen market doesn't correct this, it entrenches it. There is also a psychological shift underway. Housing in the UK has long been seen as safe, inevitable and rewarding. That belief is weakening. Younger buyers increasingly see housing as risky and illiquid. When belief fades, markets lose momentum. Demand doesn't just depend on affordability, it depends on confidence in the future. Policy responses so far have been cautious and fragmented. Small tax tweaks, limited buyer support, and gradual interest rate adjustments have failed to address the core structural issues. Policymakers are trapped between controlling inflation and restoring affordability. Moving too fast risks one problem, moving too slowly deepens another. Looking ahead, there are only a few realistic paths. One is a slow grind where prices stagnate in real terms, transactions slowly recover, and the market limps forward. Another is a prolonged freeze where low activity becomes the norm and confidence continues to erode. The third is a sharper correction triggered by an external shock, such as rising unemployment or forced sales. Markets rarely announce collapse in advance. They show stress through subtle signals: low volume, flat prices, high uncertainty, fragmentation. These are the signals we are seeing now. Housing problems never stay confined to housing. They spill into consumption, employment, politics, and social stability. Other countries have walked this road before. Long housing stagnation reshapes economies and societies. It reduces mobility, it locks in inequality, it dampens growth. The UK is not immune to those dynamics. The greatest danger is acceptance. When people stop expecting housing to work, they plan around dysfunction. They delay families. They avoid moving for work. They disengage from long-term investment. That slow shift changes a country more deeply than any sudden crash. Strip everything back, and the truth is simple. The UK housing market is not booming, it is not crashing, it is not healthy, it is stuck. And systems that remain stuck for too long do not remain stable forever. The UK housing market isn't failing loudly, it's failing slowly. Prices barely beating inflation, transactions that never happen, buyers locked out, renters squeezed, builders pulling back, councils under strain. None of these alone cause collapse. Together, they form a structural warning. Housing should be a foundation for opportunity and stability. Right now, it is becoming a fault line, and unless affordability, supply, confidence and policy direction change meaningfully, that fault line will continue to widen quietly, relentlessly, until it can no longer be ignored. That is why the UK housing market is not looking so good.